In this video, traders, we're going to look at 6 ways to use the RSI. Stay tuned. Hey traders, a very warm welcome to you. Okay, so RSI, pretty useful indicator. It's from the oscillator family of indicators, very similar to Stochastics, similar to CCI, that kind of thing. The idea is to move to an overbought, an oversold condition. I've done other videos on RSI before. This one, however, we're going to talk about 6 different ways that we can use the RSI because it's a pretty flexible and useful indicator. All right. The first one is the normal overbought and oversold, which is what most people are familiar with. When price moves up, our RSI is going to move into an overbought condition, which is in the top part of this segment here. And then when it moves down, we're going to move into an oversold condition. And the general idea is we sell when we're overbought, we buy when we're oversold. That, when back tested with different things, isn't really a winning strategy. You kind of get some wins, you get some losers. It's not really a standalone strategy to use. However, you can use it as a guide, and before I've talked about using it as a filter. So whilst I never recommend just going short when we're overbought, buying when oversold, it's a good starting point to build something from. So that's almost like the normal regular way of using RSI. Okay, the second one I've got is divergence. What is divergence? Divergence is not a bad one. Actually, I'll be interested to find out any information on back testing this kind of thing because I think it's quite useful. So in this kind of example here, this crazy little chart we've got, divergence would be here. So we have a higher high with price. So price moves to a new high. However, RSI does not. If you can just see that there, RSI does not move to a new high. So price moves to a new high, but RSI actually is a lower high. So you get that divergence between the two, potentially giving you a sell signal. So maybe you're in overbought territory, or maybe you've been overbought one, second one doesn't go overbought. That might indicate that actually this is running out of puff a little bit. I need to look at a short opportunity for it to roll over because we haven't got that new extreme in an overbought condition. That's something to look out for, and obviously flip it on its head if we took into the downside for a long. All right, look out for divergence. That's number 2. Okay, number 3 is exit only. One I'm quite a big fan of, and I've talked about this before when we've wrapped this up in terms of trying to frame your exits for swing trades. Using it as an exit only, so rather than entry, it's using another criteria to get into your trade, some sort of chart pattern, some sort of reversal, some sort of whatever it may be, it doesn't really matter. You then use the RSI as an exit. So if you're long, when you get into an overbought condition, you've got 2 ways of doing it. Number 1, as soon as you get overbought, you're out of the trade, or you scale out of the trade. The second way of doing it is once you're in overbought, you keep hold of it until you come out of overbought. And generally overbought condition is anything above 70, oversold anything less than 30. We'll talk about those in a second. So in this example, you would hold the trade and you'd either come out here when you went into overbought, or you'd wait and you'd come out here when you went into oversold. Now, pros and cons with both of those. That's a little bit early, and maybe you're going to get a nice little peak, but what you will miss out on is something that stays overbought for a long time, which they can do for a long time, RSI. This one, you're giving yourself the opportunity, obviously, for it to stay overbought and give you that extra little squeeze of juice, but it will get you out when it starts to turn. So that's a good one. I like that. That's one of my preferred ways of doing it, especially if I'm in a trade, it's kind of hit targets, I've scaled out already, and I'm just rolling this runner. I'm like, well, where's this going to go? Maybe I'll close at the end of the day if I'm day trading it, maybe look at the end of the week. But in the meantime, I might say, hey, you know what, if RSI gets overbought and comes off overbought, I'll take that, and I'll take that as a profit. So it takes your mind away from price, and you can focus purely on that RSI, which is not a bad way of doing it. And of course, you can set alerts as well on most of your chart packages if you get into an overbought condition on that indicator. Right, that's number 3. Number 4, RSI 2, extreme settings. I think it was Larry Connors who came up with this one. This is not a bad little way of doing it either. You set your RSI, normally it's set to a 14 period. I'm going to put 14 here, but what you do with this strategy is you set it to a 2 period. Now, a 2 period is going to make it very, very noisy. It's going to follow price far more. In fact, can we just squeeze it under the bottom there? We probably can. Hopefully you can see this. Let's assume that this is here. RSI for 2 is going to kind of look a lot more like this. You know, we're going to have much more extreme moves. It's not going to be as smooth. So same kind of thing. But what you do to smooth that out, so you will still obviously get this much more frequent moves because it's a lower number here. So it's taking a 2 period instead of a 14 period. Just like a moving average, you know, a shorter moving average is going to be very close to price, longer one far away from price. We get that. So you're gonna get noisy things. So to smooth it out, you use extreme settings on your overbought and oversold. So you use, instead of using 70 and 30, which is gonna be firing off all the time, you use things like extreme, like 10 or 90 or even 95 and 5. So you stretch that extreme value out. So you don't get a trigger until it goes into really extreme. So even though you're on a 2 period and it's very, very noisy, it's not going to go very, very extreme, only occasionally. So it's another way of doing it, another way of kind of looking, and it's worth putting on the chart that you're trading to see if that kind of works or it has worked previously, and whether or not that is better, or to stick with the standard rules. You get less signals, but you're bringing your overbought and oversold condition narrower. All right, number 5, midline crosses. Another way of kind of framing your trade is there's always a midline here around the 50. Well, it is 50. Let's just put a solid line here. You can basically trade it and say, hey, when the market crosses, I'm going to close or open my position. So as it's come off an overbought or oversold condition, as it's coming back through the mid, maybe I'm going to scale out of a position, maybe I'm going to enter a position, maybe I'm going to exit a position. Obviously, this is depending on what you're doing. Now, an example for that could be this. Let's say you have, in fact, this is a perfect example right here. Okay, if we didn't have this part here and we had kind of a downtrend here, that wouldn't look like that, the RSI. So let's imagine that was the price. We then came down here. We then thought, hey, I want to take a counter trend trade for a pop back up off that low. We think this is a little bit extreme. We're going to have a little nibble long. For whatever reason, maybe hopefully you've quantified a strategy and set up from that. We take our long trade there. RSI is going to be extreme. We might not think that we're going to do a full reversal and we're going to end up with an uptrend. We might think, hey, this is a mean reversion trade. Just the spring has been a bit stretched. It's going to compress back. I just want to pop back to the mean. So instead of using a price mean, you could say, hey, I'm going to use an RSI mean. So that was when you would use a midline cross for an exit. You'd be taking your long at an extreme. As it popped back up, or as price popped back up, as the RSI popped back up, as soon as it hit that 50, you're out of it. Obviously, this is a different kind of idea for your trading thesis. Thesis is it's stretch, it's going to pop back up. You don't necessarily believe it's going to rocket up to new highs. You think that this is too far and it's just going to unwind a little bit, and that's a good way of getting out of it. It's like using that as a mean as opposed to a moving average or something on prices, what you would normally do for a mean reversion type trade or a VWAP. Okay, number 6, trend pullbacks. Talk about this one quite a lot, and again, this is one of my favorite ways of using RSI. A trend pullback is, hey, you've been moving in a trend and you've been pushing on in one direction. RSI has been continually either overbought or oversold, or in the upper half or upper third of that level. So it's going to be above 50 as prices are chugging higher. Eventually you get a pullback in the trend. Could we use it here? This is not a bad kind of, this wouldn't be too bad, but maybe I should draw a fresh one for you just to kind of, I'm going to undo this. I'll keep that up there so you can see that. We've done midline crosses. Hopefully we can see this here, guys. So we are, yeah, perfect. So we've got a little bit of an uptrend here. Keep going. We're going to pull back. RSI, this is a nice way of doing it. RSI is going to be overbought. Eventually it comes oversold. First oversold condition, that's when you go long. And it's a good way of using it in a trend, whereas most people use it in an oscillating market. I've talked about this one before because it's one of my favorite ways of using it. Trend, push. The first oversold or the first overbought if you're in a downtrend, first oversold if you're in an uptrend condition is when you pull the trigger on the long or the short, i.e. getting back on the trend for a move back in the continuation. Works nicely on an intraday chart, using a time frame like a 15-minute. Also works okay on a daily. Again, you can choose whether to do it straight away as soon as it gets into the extreme condition, or you wait for it to come into the extreme condition, overbought, oversold, curl back through, then that's your trigger. Then you use a stop above or below the extreme to quantify the risk. All right, guys, that was 6 ways to use the RSI. Hope you enjoyed the video. If you did, give it a thumbs up. It is much appreciated, and stick your comments in the comments section below. I shall see you in the next one. Take care. Good trading. Bye-bye.